Good afternoon. Our group will discuss to you about risk and return, followed by the cost of capital. Our group members are Ms. Janice Ariata, Ms. Luisa de la Peña, Mr. Erwin de los Reyes, and yours truly, Ms. Criseline Anong Velones. Our first topic is about risk and return. In making business financial decisions, we consider two main factors, that is risk and return. These two affects the decision you are going to make about your investment securities. Let's now proceed to the next slide. Okay. Let's first define risk. It is a measure of uncertainty surrounding the return that an investment will earn, or more formally, the variability of returns associated with a given asset. So, in every investment, there is always a risk that you are going to take. If you're an investor, you should have and you should measure what risk are you willing to take for that certain investment. So if you have a risk, you are also have an exposure to loss or potential of financial loss. If you have an investment in stocks, you should understand the risk surrounding that investment. So let's take a look at the example. A $1,000 government bond that guarantees its holder $5 interest after 30 days has no risk. Usually, government bond or treasury bonds is a zero risk investment. It's a free risk investment because there will be no variability associated with the return. Whereas a $1,000 investment in a firm's common stock, the value of which over the same 30 days may go up or down, and it's very risky. So usually, common stocks are very risky investment because it can go up or down, depends on the market and the variability of the environment of the economy. Okay, let's now define return. Return is a total gain or loss experienced on an investment over a given period of time. So we have here the formula for the total rate of return. We have the expected or required rate of return during the period, the cash flow from the asset investment, and the price value of asset. So in this equation, it is used to determine the rate of return over time as short as day one or as long as 10 years or more. And the R in the formula, it represents the annual rate of return. So we can see here in table 8.1, it differentiated the investment from treasury bills, treasury bonds, and common stock. The average nominal return versus the average real return. You can see here that the treasury bills and bonds, the average return is lower than the common stock, which is 9.3 and 6.2. Because treasury bills and treasury bonds have a lower risk, therefore they have a lower return. Whereas the common stock has a higher risk, therefore it provides a higher return. There's another example. Okay. The example here is the comparison of Apple versus Walmart. So Robin wishes to determine the return on two stocks that she owned during 2009. You can see here, if you substitute the formula of the total rate of return, we can get the annual rate of return for Apple is equal to 132.2%, while Walmart is negative 2.5%. It means Robin made money on Apple and lost money on Walmart. But as you can see, during the year, Apple paid no dividends. But Walmart received dividends of 1.09. So it reduces the risk also in Walmart because it received dividends. But the annual rate of return is still higher in Apple than in Walmart. In risk preferences, there are three things. This is a kind of investor. So, if you're an investor, are you a risk adverse, risk neutral, or risk seeking? If you are a risk averse, your attitude towards risk would require increased return as compensation for an increase in risk. So if there's an increase in risk, y- you required an increase in return. But if you're risk neutral, your attitude towards risk, you choose to have an investment with a higher return regardless of its risk. If it is a higher risk or lower risk, the most important thing for you is you gain a higher return. If you are risk seeking, the attitude towards risk is that you prefer a greater risk, even though there will be a lower expected return. So you are a risk taker. Risk of a single asset. What is risk assessment? Risk assessment, the more uncertain you're about on how an investment will perform, the riskier that investment seems. So we have the scenario analysis and the probability distribution. For scenario analysis, a measure of an asset risk, which is found by subtracting the return associated with pessimistic or worse outcome from the optimistic or best outcome. The probability distribution, it will be as a statistical function that describes all the possible values and likelihoods that a random variable can take within a given range. Okay, so let's compare this one. We have here example for scenario analysis and probability distribution. In scenario analysis, there are asset A and asset B with an initial investment of $10,000 each. Okay. So the management has estimated its annual rate of return. When you are being pessimistic or the worst outcome of the investment, the return for asset A will be 13% and then asset B 7%. If you're being optimistic or the best outcome of that investment, the percentage of return will be 17% and 23%. But if you will check the range of the difference between the best outcome over the worst outcome, you will see that in asset A, it is 4%. And in asset B, it is 16%. It means that in asset A, it is less risky investment versus asset B because it has a wide range of uh, difference between the best outcome and the worst outcome. So if you are looking for an investment, you will prefer asset A that will give you a return of 17% and the worst is 13% over asset B that even though it has a higher best outcome 23 but the worst percentage of return is 7%. So it can deviate from a wide variety of situation. But if you are an investor and you are being less risky and being safe, you will choose asset A. Okay. Given the probability distribution, so it has a 25%, 50%, 25%. So in this graph, using the 25% and 50% probability versus the rate of return. In asset A, you will see here that if the probability of occurrence is 50%, the return here is 15%, but the range is very small. Whereas in asset B, it has a wide range of probability of your return if the probability of occurrence is 25 to 50%. Let's talk about standard deviation. Standard deviation, it measures the dispersion of an investment's return around the expected return. The expected return is the average return that an invested expected to produce over time. So standard deviation, we need to remember that the higher the standard deviation, there is a higher risk in an investment and therefore a higher return. If your standard deviation is lower, you expect a lower risk and a lower return. Let's check the example for the expected value of return and standard deviation. So let's check here example 8.4. Okay. They the probability here are given. So they have 25%, 50, and 25. And the returns are 13%, 15, and 17. When you multiply the probability times the return, annual rate of return, you will get the weighted value. So for example, the pessimistic 25% probability times the 13% return, you will get 3.25%. And the total expected return is 15% for asset A and asset B. So you will see here that they have the same expected return, 15%, and they have both 15%. In standard deviation, in standard deviation, we'll see here that in asset A, the standard deviation calculated is 1.41%, whereas in asset B, the standard deviation is 5.66%. It means that asset B has a higher risk of investment with 5.66% versus asset A that has only have 1.41% in its standard deviation. So if you are a risk taker investor, you will choose asset B. But uh if you are not risky or you prefer a low risk investment, you will choose asset A. Return on a portfolio. What do you mean by that? So it is a weighted average of the returns on the individual assets from which it is formed. So basically, this is the this is the amount of return you will get from your investment and earn it in your whole portfolio. So we will check here the formula and the example. James purchases 100 shares of Walmart at a price of $55 per share. So his total investment in Walmart is $5,500. He also buys 100 shares of Cisco System at $25 per share. So total investment in Cisco is 25. If we combine these two holdings, the total portfolio is worth 8,000. So if we get the percentage of that, we get 68.75% is invested in Walmart and 31.25% is invested in Cisco. Standard deviation of a portfolio's return is found by applying the formula for the standard deviation of a single asset. If you check here the example of the expected portfolio returns over 5 years, so starting from year 2013 to 2017, the forecasted return per asset in asset X is this one, 8, 10, 12, 14, 16. And in asset Y, 16, 14, 12, 10, and 8. If you get the portfolio return of that using 50% probability, you will get the expected portfolio return of 12%. So in this case, it will be 12% expected return on the portfolio every year from 2013 to 2017. It means that the investor will be expecting 12% return to his portfolio investment over the period of 5 years. Let's talk about correlation. Correlation is a statistical measure of the relationship between any two series of numbers. So they have positively correlated. It means two series that move in the same direction. Negatively correlated, two series that move in opposite direction, like this one. This is like correlation coefficient, a measure of the degree of correlation between two series. It is a number that measures the strength and direction of a linear relationship between two variables. Next is perfectly positively correlated. It is two positively correlated series that have a correlation coefficient of 1. And the negative, perfectly negative correlated, two negatively correlated series that have a correlation coefficient of 1. If you check the graph here on the side, this is a perfectly positively correlated. It, it has the same direction. Whereas the perfectly negatively correlated, it moves in the opposite direction using the same correlation coefficient of 1. Diversification. Okay, the concept of diversification is that you don't put your asset in one basket, or you don't put your investment you don't choose an investment in a single company. You put your basket in a different investments. So you can invest in bonds, and then you can invest in stocks, you can invest in bills, you can invest in real estate. That's diversification. So two or more assets are important to and combine it in a portfolio than buying only one single investment or asset. Because when you have a single asset investment, when that investment goes down, so you incur a loss totally. But if you have a portfolio with different investments, then it will somehow manage the risks. Some investment will go up, some investment will go down, and some investment will go in a neutral way. Correlation, diversification, risk of return. In general, the lower the correlation between asset returns, the greater the risk reduction that investors can achieve by diversifying. If we can see here in another example, if the portfolio return ranges from 6 to 8, and there will be no other correlation. So the ranges of return will go this way. It will not be more than or less than. Okay. Let's consider two assets, low and high. We can see here that the expected return for low is 6% and its risk is 3%. In high, the expected return is 8% and the risk is also 8%. Clearly, asset low has a lower return than high, therefore it is less risky. High is a more riskier investment. The performance of a portfolio consisting of assets, low and high, depends not only on the expected return and standard deviation, but also on how the return on two assets are correlated. So we can see the results of the analysis appear in this graph. Whether the correlation between is plus 1 or minus 1, all range between 6 and 8%. However, the standard deviation of portfolio depends critically on the correlation. Only when low and high are perfectly positively correlated. So if they are perfectly positive, plus correlation of 1 and then perfect negative at 1, it will not move. It will just be the range of 6 to 8. So as the correlation between low and high becomes weaker, investor may find that they can form portfolio with the standard deviation that are even less than 3%. So if it is not perfectly correlated negative 1 are not perfectly correlated in positive, so the range of risk may deviate and the annual return may also change and vary. It is possible to diversify away all the risk and form a portfolio that is risk-free. Usually, risk-free investment are government bonds or treasury bonds. International diversification. When you say international diversification, so we include foreign assets in a portfolio. So it ranges assets from countries rather than in one country. So it depends on the market movements. If the market goes up and down of different markets around the world, they can offset each other. The effect of the investment diversification can offset to each other. And the result of that portfolio is less risky than the one invested entirely in just one country. So if you have international diversification for your investment, you have a return also that diversified your portfolio. So it tends to perform better if you diversified your investment rather than purely domestic portfolio. So in shorter over short period of time, a year or two, usually it may perform better or worse than domestic portfolio. Your return in your international diversification varies depending on the economy of the countries that you are investing into. So usually you have a risk of international diversification. In this, the most important risk is political risk because the possibility that the host government will take actions harmful to foreign investors or that political turmoil in endanger investment. Political risks are particularly in developing countries. They can be stable or they can be unstable depending on the motivated government or they can attempt to block return of profits by foreign investors or even seize their assets in the host country. As we can see, if you have international diversification, you may incur greater risk because it will depend on the political side of the government and the economy of that country. If you have a greater risk, you have a greater return. Let's talk about the capital asset pricing model, the CAPM. The basic theory that links risk and return for all assets or portfolio of assets. Let's see the type of risk. Total risk, the combination of a security, non-diversifiable risk, and diversifiable risk. So we have diversifiable risk. Diversifiable risk is also known as unsystematic risk. It's a portion of an asset risk that is attributable to firm specific random causes can be eliminated through diversification. So this is controllable. If you have diversifiable risk, this risk is controllable because you can just diversify your investment and you can control and eliminate uh, the major risk that you have. If you have non-diversifiable risk, this is also called a systematic risk or non-controllable because it cannot be eliminated through diversification. Usually it attributes to market factors that affect all firms. The capital asset pricing model links non-diversifiable risk to expected returns. So the five section of this model is beta coefficient, the graph security market line, the equation, some comments on the CAPM and shifts in the security market. Beta coefficient. It is a relative measure of non-diversifiable risk, an index of the degree of movement of an asset return in response to a change in the market value. It measures how much asset moves with the market. The higher the beta, you get the higher risk and higher return. This figure 8.8 shows the graphical derivation of beta for asset R and S. So you can see here the movement of asset S is greater than the movement of asset R. It means asset S has a higher beta than asset R. Okay, let's check the equation. Using the beta coefficient to measure the non-diversifiable risk, it is given in this equation. Whereas R is the required return on asset, R here is the risk-free rate of return. This is commonly the treasury bill or government bonds. Beta coefficient or index of non-diversifiable for asset and the market return. If we'll check here in this formula, this is the risk-free rate of return. Zero risk treasury bonds. This formula, this called the risk premium, whereas it consists of the beta and the market premium. Okay. Okay. In this slide, it's talking about the security market line. So security market line is the graphical depiction of a capital asset pricing model. So it is a graph that reflects the required return in the marketplace for each level of the beta. So if you can check here the example, the risk-free rate was 7% and the market return was 11%. So if we plot it in the security market line, this is the risk-free rate of return, the 7%. And then the market return of 11% is here. When you have a beta of 1, if you have a beta of 1, the required return is 11%. But if you have a beta of 1.5, the required return is 13%. Because in the rules, the higher the beta, the higher the return. Shifts in the security market line. So in the given example, there can be changes in the security market lines. So the cause of that will be the inflationary expectation. So when the market experience inflationary, so the security market line will go up. So when the security market line will go up, if you have a beta of 1, your return will also move upwards. It will be 14%. If you have a beta of 1.5, your expected return, required return will be 16%. It will also go up. The important lesson here is that a given change in inflationary expectations will be fully reflected in a corresponding change in the terms of all assets, as reflected in the graph of the SML. So you can see here the increase is due to the impact of inflationary expectation. Okay, let's read some comments on the CAPM. The capital asset pricing model generally relies on historical data. The betas may or may not actually reflect the future variability of returns. Therefore, the required returns specified by the model can be viewed only as a rough approximation. So explaining here, the beta can be the actual or cannot reflect the actual of the variability of returns. It can be a rough approximation. The CAPM was developed to explain the behavior of security prices and provide a mechanism where investors could assess the impact of proposed security investment and overall risk and return. It is based on the assumed efficient market with the following characteristic. Many small investors, all having the same information and expectation with respect to securities, no restriction on investment, no taxes and transactions, and rational investor. So although the perfect world described in preceding paragraph appears to be unrealistic, studies have provided support for the existing of the exceptional relationship described by the CAPM in active markets, such as the New York Stock Exchange. So this CAPM is also used widespread in different corporations. So it is used by the corporations to assess the required return that their shareholders demands. So again, in this discussion, we always remember that if you have a higher risk in your investment, you can expect a higher return. But if your investment has a lower risk, the return will also be lower. Another example of a higher risk, if you're investing in a common stock, like for example, you're investing in a stock of San Miguel or stock of SM, so they can pose a greater risk or higher risk because they will be based their market price on the movement of the economy. So sometimes when the economy is going in a downward, the market price of that stock or investment will also go down. So you incur a higher risk with that. But if the market situation goes up, so their market prices are also increasing. So with this, thank you very much, everyone. And our next topic is the cost of capital that will be discussed by our group members, Mr. Erwin and Miss Luisa. So I hope we've learned about this topic of risk and return. And thank you, everyone, and good afternoon.
Good morning, classmates. Good morning, Sir Alan. For the continuation of our report, once again, we are the Group 2, and my name is Erwin, and the members of the Group 2 are Arayata Janice, De La Peña Luisa, De Los Reyes Erwin, and Balones Criselin. Miss Luisa and I will present the cost of capital for the entire Chapter 9. In this chapter, I will be discussing about basic concept, the cost of long-term debt, the cost of preferred stock, and calculating weighted average cost of capital. And my teammate, Miss Louisa, will be discussing the cost of common stock, the cost of retained earnings, and weighing schemes. The basic concept. A firm cost of capital is estimated at a given point in time and reflects the expected average future cost of funds over the long run. Although firms typically raise money in lumps, the cost of capital reflects the entirety of the firm's financing activities. In this chapter, it shows four basic sources of long-term capital, such as long-term debt, preferred stock, common stock, and retained earnings. To understand the basic concept, here's the example 9.1 explaining the long-term capital. A firm is currently faced with an investment opportunity. Assume the following. Best project available today. The cost is $100,000. The life is 20 years. Expected return is 7%. The least costly financing source available, the debt is 6%. Because it can earn 7% on the investment of fund costing only 6%, the firm undertakes the opportunity. Imagine that 1 week later, a new investment opportunity is available. Best project available 1 week later, the cost is $100,000, life with 20 years, expected return of 12%, and least costly financing source available, equity, is 14%. In this chapter, we're going to understand and how to decide in terms of investment. The cost of long-term debt. The cost of a long-term debt is the financing cost associated with new funds raised through long-term borrowing. Typically, the funds are raised through the sale of corporate bond. The net proceeds. The net proceeds from the sale of a bond or any security are the funds that a firm receives from the sale. The total proceeds are reduced by the flotation costs, which represent the total cost of issuing and selling securities. Two components of cost. One, underwriting cost, compensation earned by the investment bankers for selling the security. Second, the administrative costs, issuer expenses such as legal, accounting, and printing. Let's take a look of the example 9.2. Duchess Corporation, a major hardware manufacturer, is contemplating selling $10 million worth of a 20-year, 9% coupon bonds, each with a par value of $1,000. Because bonds with similar risks earn returns greater than 9%, the firm must sell the bonds for $980 to compensate for the lower coupon interest rate. The flotation costs are 2% of the par value of the bond, or $20. The net proceeds to the firm from the sale of each bond are therefore $960. Before tax cost of debt. The before tax cost of debt, RD, is simply the rate of return the firm must pay on new borrowing. A firm before tax cost or debt for bonds can be found in any of the three ways: quotation, calculation, and approximation. Using market quotation, a relatively quick method for finding the before tax cost of debt is to observe the yield of maturity on the firm's existing bonds or bonds or similar risks issued by the other companies. The market price of existing bonds reflects the rate of return required by the market. For example, if the market requires a YTM of 9.7% for a similar risk band, then this value can be used as the before-tax cost of debt, RD, for new bonds. Bond yields are widely reported by sources such as the Wall Street Journal. Calculating the cost. This approach finds the before-tax cost of debt by calculating the YTM generated by the bond cash flows. From the issuer's point of view, this value is the cost to maturity of the cash flows associated with the debt. The cost to maturity can be calculated by using financial calculator or an electronic spreadsheet. It represents the annual before-tax percentage cost of the debt. Cost of preferred stock. Preferred stock represents a special type of ownership interest in the firm. It gives preferred stockholders the right to receive their stated dividends before the firm can distribute any earnings to common stockholders. Preferred stock dividends. Most preferred stock dividends are stated as a dollar amount, X dollar per year. Sometimes preferred stock dividends are stated as an annual percentage rate. This rate represents percentage of the stock's par or face value that equals the annual dividends. Here's how calculating the cost of preferred stock. The cost of preferred stock, RP, is the ratio of the preferred stock dividend to the firm's net proceed from the sale of the preferred stock. The net proceed represents the amount of money to be received minus any flotation cost. Equation 9.3 gives the cost of preferred stock, RP, in terms of the annual dollar dividend, DP, and the net proceed from the sale of the stock, NP. So therefore, as you can see down, RP is equal to DP over NP. Let's take a look at the example 9.7. Duchess Corporation is contemplating issuance of a 10% preferred stock that they expect to sell for $87 per share. The cost of issuing and selling the stock will be $5 per share. The first step in finding the cost of the stock is to calculate the dollar amount of the annual preferred dividend, which is $8.70. The net profit per share from the proposed sale of stock equals the sale price minus the flotation cost. Substituting the annual dividend DP of $8.70 and the net profit NP of $82 into equation 9.3 gives the cost of preferred stock 10.6%. The cost of Duchess preferred stock 10.6% is much greater than the cost of its long-term debt, 5.67%. This difference exists both because the cost of long-term debt, the interest, is tax-deductible and because preferred stock is riskier than the long-term debt. Let's go now to the weighted average cost of capital, WACC. Reflects the expected average future cost of capital over the long run, found by weighing the cost of each specific type of capital by its proportion in the firm's capital structure. Calculating weighted average cost of capital. This is the equation. RA equals to the product of WI times RI plus the product of WP times RP plus the product of WS times RR or N, where WI is the proportion of long-term debt in capital structure, WP is the proportion of preferred stock in capital structure, WS is the proportion of common stock equity in the capital structure. WI plus WP plus WS is equal to 1.0. Three important points should be noted in equation 9.9. 1. For computational convenience, it is best to convert the weights into decimal form and leave the individual costs in percentage terms. Second, the weight must be non-negative and sum to 1.0. Simply stated, WACC must account for all the financing costs within the firm's capital structure. Third, the firm's common stock's equity weight, WS, is multiplied by either the cost of retained earnings, RR, or the cost of a new common stock, RN. Which cost is used depends on whether the firm's common stock equity will be financed using retained earnings, RR, or new common stock, RN. Let's take a look now in example 9.12. In earlier example, we found the cost of various types of capital for Duchess Corporation to be as follows. Cost of debt is 5.6%, cost of preferred stock 10.6%, cost of retained earnings 13%, cost of new common stock 14%. The company uses the following weights in calculating its weighted average cost of capital. Sources of capital: long-term debt weight is 40%, preferred stock is 10, common stock equity is 50, with a total of 100%. Because the firm expects to have a sizable amount of retained earnings available, $300,000, it plans to use its cost of retained earnings as the cost of common stock equity. Duchess Corporation weighted average cost of capital is calculated in Table 9.1. The resulting weighted average cost of capital for Duchess is 9.8%. Assuming an unchanged risk level, the firm should accept all the projects that will earn a return greater than 9.8%, which is the WACC. This ends my presentation, and I will hand over you now to Ms. Luisa to discuss about the cost of common stock, the cost of retained earnings, and the weighing scheme. Thank you very much.
Good afternoon, everyone. My name is Luisa. Before I continue, I'd like to express my gratitude to our team, Ms. Chinese, for creating our efficient and lively slides, Ms. Chrisline for sharing her expertise on risk and return analysis. By the way, she is a CPA. Mr. Erwin, based in Qatar, despite a 5-hour gap from Philippines, he can still accommodate our catch-ups online. And of course, Sir Alan, thank you for your patience and generosity. Before we deep dive to the cost of capital, I would like to give you an overview of the cost of capital. What is cost of capital? It is a minimum return a project must earn to increase firm value. And the ultimate goal of the firm is to maximize shareholders' wealth by investing in valuable projects. And what is the decision of benchmark? If a project's return is higher than the cost of capital, it adds value to the firm. If a project's return is lower, it reduces firm value. Ethical responsibility is the financial managers should only invest in projects that are expected to exceed the cost of capital. And the long-term impact is the cost of capital influences the firm's investment decisions and affect shareholder wealth based on the market value. Continuing with the cost of capital, understanding the cost of capital helps in making better long-term decisions and maximizing personal wealth. I will just need a few minutes of your time to discuss the cost of common stock, retained earnings, and weighting scheme. Okay, again, we have to define what is the cost of common stock. It is a return a company must provide to its common stockholders. It is like a compensation for their investments. This represents the required rate of return based on the risk and opportunity cost of holding the company's stock. In simple terms, ito yung kitang inaasahan ng mga namumuhunan Ito yung kinakailangang ibalik or parang kompensasyon ng isang kumpanya sa mga namuhunan or nagbigay ng dagdag na kapital. Ito yung inaasahang kita base sa panganib o oportunidad ng paggalago ng isang kumpanya o pagkalugi. And why it is important? The cost of common stock is a key component of companies' cost of capital. It helps evaluate long-term projects, investments, and financial decisions, ensuring return meets or exceed shareholder expectations. And what are the methods to measure the cost of common stock? As you can see here, there are two techniques used to determine the common stock equity. The constant growth, valuation, or it is also called as Gordon growth model, and the capital asset pricing model, or the CAPM. Now, the constant growth valuation model. What does it mean? If the dividend grow at a constant rate, we can use the growth valuation formula. Kung ang dividendo ay tumataas ng tuloy-tuloy, magagamit natin ang constant growth valuation formula. What is the concept of this formula? This method assumes that the value of a stock equals the present value of all future dividends, which are expected to grow at a constant rate indefinitely. For example, in order to know the rate, let's substitute 4 divided by $50, and that's equal 0.08. And then 0.08 plus 0.05 equals 13%. It represents that the returns to the stockholders, the downside, if it's lower than the most likely, investors are likely to begin selling their stocks. The second method is CAPM, or the Capital Asset Pricing Model. It is used to determine the required rate of return for an investment based on its non-diversifiable risk or systematic risk, which is measured by the beta coefficient to understand further. And let's digest. The capital asset pricing model calculates the required return on the equity, or RS, by considering the risk-free rate of return, or RF. This is the return on a risk-free investment such as government bonds. The market return, the expected return of the market portfolio, it is being measured by beta coefficient. It is the firm's sensitivity to market risk, how much its stock price moves in relation to the market. Non-diversifiable risk, or systematic risk, these are unavoidable risks that affect the entire market, including economic recession, inflation, interest rate, or geopolitical events such as wars, pandemics, political tensions, and measured by beta coefficient. If it's less than 1, it is less volatile than the market. Lower risk, lower return. If it's more than 1, more volatile than the market. So it's higher risk, higher return. The importance is CAPM, or CAPM, helps investors and companies to evaluate risk-adjusted returns by linking required return to market risk, making it a key tool for financial decision. As you can see in the example here, the cost of common stock equity, this is the formula, is equals to 13%. So you have to compute first those value within the parentheses and add it. So first, you have to subtract 11 minus 7 and times to 1.5. And after you get the sum here, you just add to 7.0, which is, and then plus 6.0%, which is equivalent to 13.0%. Take a look on this, where you will see the substitute of each formula. Okay, then moving on to the next slide. The other source of long-term capital is the cost of retained earnings. What is the cost of retained earnings means? Imagine you're running a milk tea stand. You could borrow money from the bank to buy more milk tea powders or boba or the ingredients for your business, which is the milk tea stand. You borrow money through a bank or debt financing. Or you could use your own savings, which is called equity financing, specifically retained earnings. The cost of retained earnings is essentially the opportunity cost of using your savings to grow business instead of investing it elsewhere. What could you have earned if you'd put that money in a savings account or invested it in a stock market? That potential return is the cost of using your own money. You're giving up the chance to earn that money somewhere else. So, it's not a literal cost like paying interest on a loan, but it's a missed opportunity cost. It represents the return you could have gotten on your money if you hadn't used it for your business. We use a similar return, like the return on a similar company's stock, to estimate this opportunity cost. It is very straightforward. As you can see here, that RR is equals to RS. It implies that the required rate of return on retained earnings is equals to the required return on the company's stocks, which is RS. In this example, the Duchess Corporation calculated the same. It is 13.0%. Okay. The cost of new issues of common stock. Imagine again your milk tea stand needs more money to expand, and you've already used your savings, the retained earnings, and now you need to sell new shares of your milk tea stand company to raise a capital. This is called issuing new common stock. So in this example, it explains how to calculate the cost of issuing a new common stock, which is usually higher than the cost of existing common stock because of underpricing. It means selling below the market price. So from 50, it became 44.50. The Duchess Corporation plans to issue new shares, and here's the scenario. The market price is $50, but new shares are sold for $47. So it's like down by $3. The flotation costs are 250, 2 point and 2.50 per share. The total deduction is equals to $3 plus 2.50 is equals to 5.50 per share. The net proceeds is equals to 50 minus 5.5. That's why it became 44.5. Okay, using the formula, so the cost of the new stock is 14% here. Okay, weighting schemes. What does it mean, weighting schemes? This is used to calculate the proportions of different types of capital, such as debt or equity. In a company's financial structure, they use weighting schemes to decide how much importance to give to each source. There are 4 types of weighting schemes, such as book value, market value, historical weights, and target weights. This method, the first one, which is book value, it uses the values from the company's balance sheet or accounting records, and it considers the original recorded value of debt and equity, not the current market price. For example, if the debt is $2 million and equity is $3 million, so obviously the total capital is 5 million. So the book value weights would be 2 million divided by 5, which is the total capital, is equals to 40%. And the equity weight will be 60%, which is 3 million divided by $5 million. Okay. It is good for long-term stability but may not reflect the current market conditions. Second is the market value weights. This method uses the current market value of debt and equity, what investors are actually willing to pay. More realistic because market prices fluctuate. For example, if the market value of debt is $400,000 and the total market value of capital is $1 million, the debt is 40%. It uses real market prices. It is realistic, but it fluctuates. Example, the company's debt in the market, let's say valued at $1.5 million, and the equity is trading at $4 million. So the total market value capital is equals to 1.5 million plus 4.5 million is equals to 6 million. The market value weights would be that is 1.5 million divided by 6 million is 25%, and the equity weight is 70%. It is good for reflecting the real world conditions but can change frequently. And thirdly is the historical. This uses past capital structure percentages and instead of current values. That's why it is called historical. Based on the previous financing decisions, example, last year, debt was 35% of total capital. And this year, the same weight is used. So it uses the past ratios, which is good for consistency, and future goals, which is best for planning or forecasting. And lastly is the target weights. It is based on the company's desired planned proportional of capital. For example, if a firm wants to maintain a 50% equity and a 50% debt structure in the future, it will use those target weights. A company wants its capital structure to be 40% debt, 60% equity. If current market values are different, it will adjust future financing to reach this target. It is good for long-term financial planning actually. So historical weights, target weights, these are uses for future and better planning. The example compares two options to determine the least costly decision for Chuck Solis, who currently has 3 loans and considering consolidating them into a new single loan. I'll explain. So Chuck has 3 loans with the following details. As you can see here, loan 1, 2, and 3, 26,000 at 9.6, 9,000 at 10.6% interest, and loan 3 cost $45,000 interest at 7.4. So the total loan balance is 80 grand. Chuck finds a lender willing to loan him 80 grand for 6 years at 9.2%. That's the interest. So the 9.2% times 80,000, this allows him to repay all the 3 loans in one go. So to decide, he calculates the weighted average cost of his current debt. So the formula for weighted average cost, as you can see in this example, is the weighted average cost of Chuck's current debt is 8.5. So you can see it's 8.5, which is lower than the 9.2 rate that's being offered to him. Chuck should do nothing and continue repaying his current loan as this is the cheaper option. So they have been decided that Chuck should go to continue paying the his loan as per the term instead of getting 80,000 and pay it on the go, and it has 9.2 interest. Okay, as a key takeaway, as Mr. Benjamin Franklin said, an investment in knowledge pays the best interest. What does it mean? It means that finding the sweet spot, the best mix of loans, savings, and shares, it depends on your situation. Too much debt is risky, too much equity limits its growth. So the goal is to find the right mix that keeps your cost low and your risk manageable. By using those market values and what things are worth today is usually a better way to figure out this mix. So that's all that that concludes our discussion for the cost of capital, and we hope that you have learned something, and thank you so much.